Just get to this issue of throwing around this term trade war. A set of proposals and another set of proposals and potentially a 60-day negotiation process and a hearing about those proposals doesn't sound like a war to me. Does it sound like one to you?
No, I think this is a negotiation. I'm sort of happy it's happening at a time when global growth has accelerated, and certainly in developed markets it's sort of above trend. I think sort of the bigger picture here, though, is those leading indicators have been rolling over for 2-3 months here. So I think that's why markets, to the extent they're concerned about this, actually are. Let's
just get to what's happening with risk assets more broadly. I mean, my message this morning was wake me up when the trade war actually starts, because I don't see a big bid into 10-year treasuries. I don't see a big bid coming into bonds. I don't see a big bid in the yen. I see a marginally stronger Japanese yen. I see a marginally higher gold price, and I see marginally lower 2-year and 10-year yields. I would have thought, Omar, if this was really a broad risk-off mood on the back of a real potential for a trade war between the two largest economies in the world, that we'd begin to take out rate hikes from the Federal Reserve for this year. I don't see that. I don't see a market that's responding by throwing everything out all at once. Do you?
No, I think right now we can call it a trade battle and a trade discussion as opposed to an actual war. I think, you're right. The credit market is pretty, calm. The treasury market is pretty calm. The dollar is pretty calm. Overall, you think about an escalation war, that would actually be a lot of volatility there. So this is really more, a reaction on risky assets, particularly on equities that are in a new volatility regime.